real estate being cyclical, the land from 21 to 24 was not really a good time to buy. It was a good time to sell. Now is a good time to buy because now you have all of these situations that have translated in price adjustments. Interest rates are higher, but this is the time to really harvest opportunities.
Real estate, especially at a large scale, talking about multifamily properties, something, it is very much, as you said, each asset is almost like its own business, but you do have to look at them on an individual basis. Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm here with Alex Roudi. Alex is a founder of multiple companies. The first company was started with $8,000, and he built it to a $250 million per year international organization. So, Alex, I'm sure it wasn't that simple. I'm sure it wasn't insert $8,000, create $250 million of revenue. I want to start with thank you. Thank you for coming on the show today. I appreciate you taking the time out to chat with me. I'm excited to hear about your business journey or multiple businesses. So thank you for being here today.
Oh, you're welcome. It's my pleasure to be here and join you on this.
Awesome. Well, can you tell us a little bit more about yourself, your background? And we'll of course talk about the business ventures, but just let the listeners know a bit about you.
Perfect. Hello, everyone. I'm Alex Roudi. I was born in Iran, and I went to high school in the UK, came to the States to go to college. I went to Purdue for undergrad in civil engineering, and then I went to UC Berkeley for grad school, structural engineering. I was primarily doing this to go back to Iran. We had some family business operations that was in the construction field. And as I was getting my degrees, we had actually right at the end, we had a big event, a revolution back in Iran that resulted in my family losing essentially everything that they had. That was a very similar story to a lot of other people in Iran. So what that led me to do was to really stay in the US. I was in San Francisco at the time, and I started working in an engineering firm, designing nuclear power plants. I did that for about 2.5 years or 3 years. And then through a series of events, was always interested in getting a business started. And I started my first company, which is called Coverall. Coverall, and it was essentially Coverall Cleaning Concepts, which was involved in providing services to different types of buildings. These are commercial cleaning services, industrial cleaning services. But we were doing this with a little twist. And the twist was we kind of married the depth of this market, which is something everyone needs to have. All these premises need to be taken care of, with the desire of a lot of people that want to own their own business. And so we created a franchise system where we would come in and we would provide the training, provide the initial equipment supplies package, and the individual or individuals would really get into their own cleaning business with our help. However, because the business was primarily operated at night and they didn't really need to get any of the accounts, all the accounts were provided by us. They did not need to quit their daytime jobs. So as a result, they had the security of keeping their jobs going, but doing this work in the evenings primarily with their families. And that would create an extra income for them to put their kids through college or do other things that they needed to do. But having them as the service providers made a huge difference because they were highly motivated. They had an investment at stake. If they would lose the customer, they would lose part of their investment. And so as a result, our service quality was maintained on an ongoing basis at a much higher level than what you had your typical cleaning company. And whereas in a typical cleaning company, you would have turnover of customers of over 50% a year. So you would lose one out of two, because it's easy when somebody doesn't, take care of the facility, cleaning the waste baskets, etc. You have discontent, and eventually someone would cancel the contract, and somebody else would pick it up. In our case, our loss rate was around 17-18% annually, so it was a fraction of the national norm. So that led us to grow quite rapidly, actually. So I essentially had that business for around 13 years, and we grew it to around 4,500 franchise units. We had 66 offices in the US and in several other countries, and it became an attractive platform. And I ultimately sold it to two private equity firms, and basically that gave me the capital to start doing other things with my business ventures, which I did, and eventually got me to the present company that I'm running.
Okay. Well, let's pause there, because that in and of itself has a lot of I think pretty fantastic lessons for people to learn. Pretty fantastic idea, and obviously extremely successful. So, commercial cleaning services. There's a lot of talk of boring businesses, the small business area or asset class where people, you might think about software companies and things like the Ubers and Nvidias of the world as these really gold mines in a way, but people often forget about what you can do with a basic service type of industry, and commercial cleaning is a great example of that. There's many examples of it. One thing that you touched on, which I think is worth kind of highlighting, is that how you solved for the turnover within your customer base, because it sounds like a significant number to go from 50% turnover to 17 or 18% turnover, but I think that's even magnified, because if you're having to replace one out of every two customers and then also grow, it takes a lot more work and a lot more, whether it's capital or time expenditure to grow a business. But when you're able to reduce the amount of turnover, it's sort of exponentially increased the speed with which you can grow that company. If you're, keeping basically one in every 10, keeping 8 out of 10 of your customers. So I'd love for you to kind of go in a little bit more on that, Alex. Talk about, kind of your model and mindset around why you were able to maintain that quality. I think a lot of people have used service companies, and the sales pitch might be great, and maybe the first couple times you receive that service, it seems really good, but it does tend to trickle off over time, and I'm sure that probably attributes to some of that turnover. But I wanted you to maybe just dig in a little bit more on your thought on that.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Good point. So let's take that as an example, and I will then parlay that to what I'm doing today. But when you look at a typical cleaning company, the way that they operate is that they get the contract, and then traditionally who carries out the services are low wage employees that really look, nobody's making a career out of remaining as a janitor or as a cleaning
Right.
individual. So they're inherently transient in nature. So with that, if you have a turnover of that at that level, and you don't have enough of a motivating factor behind them, eventually what happens is that your level of quality would be reduced, because somebody may not show up, and the people that are there may have to cover that person, and as a result, the service quality of that night, that evening would go down, and that's just one example of how service quality would go down. And another one would be that again, if you have a account that or a building that is not a huge building, and you only have, let's say, 2 people working to provide the services in that building, and if one person doesn't show up, or worse yet, if both of them don't show up for whatever reason, you have 50 to 100% reduction in your service quality, and that would end up with a dissatisfaction. In the way that we were doing it, we essentially married the motivation that comes as a result of somebody's pride and somebody's investment in that ownership of business. That would translate for that person to go the extra mile. So by providing the resources that we were providing, which were, we would take care of all the administrative work, of all the customer relations, and you as the franchise owner had to just focus on providing the service. Now marrying that with the fact that you have, an investment at stake, and coming into this as a choice whereby you wanted to really expand in this business, you have the highest motivation to keep customers happy. That resulted in maintaining that quality of service for the people to really go that extra mile. So that's how we accomplished that goal. It's not just on its own that you just, since they're the owners, they're going to take care of everything. You have to also bring the other resources we were bringing to the table for them. Coming to the current business that I'm doing, which is a company that I founded about 20 years ago, which is called Interwest Capital. So we are in the real estate investment arena. And on the real estate investment arena, the way that we operate, we look at every deal, at every opportunity as a standalone business. And for as such, we have a business plan for that individual project, with that acquisition. And that, the way that we provide, that we put together the capital stack, how much debt we put on there, how much equity we put on there, how much equity we bring in from investors versus how much equity we bring in for ourselves. All of that comes into play on a deal by deal basis. And I like to keep it I like this format because what it does, it provides the investor with a holistic view of that opportunity. We're completely transparent, and in every deal, I personally put a significant amount of that equity myself, and the rest of it is coming from different investors that we bring to the table. Now, all of that's great. So now we have a potential target of acquisition. We have a business plan for it, and we have the capital. So we can close on the deal, but that business plan calls for certain things to happen at certain times, different milestones and different assumptions that we are making in order to achieve our business objective. Those assumptions are, number one, the way that we go about it. We are very conservative, so we look at really reducing the downside risk, and we feel that having happy in this case. In the previous case, it was happy customers, happy end users, happy franchisees. In our case now, it becomes happy tenants, happy investors, happy owners. So we provide now a way to accomplish those business goals, and that is by hiring the best in class third party management companies in every region that we operate. But more importantly, we as a company, we have a team of asset managers. Each one of our asset managers is incentivized towards certain targets that they need to achieve on a year in, year out. That is based on, again, our initial financial pro forma. So they have that sense of ownership. And so we like to say they always own a piece of each one of the deals. And with that mindset, again, with providing all of the resources here, very similar to what we were doing at Coverall, now we are essentially taking this business plan, cutting it into different pieces, and having for each one a timeline for its achievement. And then through the resources, through the people that are in charge of monitoring the day-to-day activities of the third-party management companies, when we put all of that together, we can achieve the results that we were looking for. So following that principle of bringing that ownership mentality into our team, into every member of our team, together with sound principles of business principles and assumptions, have led us to today. We have, from our inception to today, I think we have realized gains of something over 30% IRR and something over 2.4x return. So these are all, again, things that you cannot just do if you're doing things haphazardly. So we have a plan and we go about it on that way.
Yeah, no, it's great points. I mean, and in real estate, especially, well, yeah, real estate, especially at a large scale, talking about multifamily properties, something, it is very much, as you said, each asset is almost like its own business.
That's right.
And with your franchise experience, it's nearly exactly like that, right? You're kind of that parent company running each of these individual assets, franchises, whatever you want to refer to underneath. But you do have to look at them on an individual basis. You may have your overarching company principles and kind of guidelines for whether it's underwriting or management, but at the end of the day, the assets may be in a different market. They may be different asset class. You may have different regional, natural disasters. I mean, things can happen individually in certain areas. So I do like that point of sort of your approach to this, as it's. And the other part about I really like, and I wish, in a lot of ways, I wish a lot more business practices were accountability and performance based, and I think the way that you're able to do that is through essentially creating some sort of ownership, whether it's actual ownership or incentive based or performance based compensation to your team, with very specific defined and realistic metrics. Did you? Is that something? Was that a kind of a thought process and approach that you always had? Is that something that developed for you as you developed all of these franchises? Like, how did that approach to business development and management
Come together.
come to you in terms of how you run things?
Oh, good question. So I think what happened was, starting with the the franchises and the franchising system that I started with. Um, Eventually, I realized that that same sense of ownership and pride of ownership that our franchisees have need to really be instilled in our employees at different levels, and especially people that have that are in charge of sensitive areas of the business. So we have different thresholds and so forth. So what we created at that point was what we called a phantom stock ownership program. So together with that phantom stock ownership program, people would be, in different ways, would end up owning certain number of these phantom stocks. The reason they were called phantom stocks is that they weren't actually stocks, but they behaved like stocks. So they had a value assigned to them based on our financial performance. And then if somebody wanted to leave, they had different ways of really buying those shares back, etc. So that sense of ownership, we tried to permeate that throughout the organization. And in that company, we had with all the different offices. So we had a lot of people, and it was very important how you really make them each feel like they're owning their piece of the pie and the piece of the work. So moving then coming to this business, again, what I realized was that each one of our investors is each one of our deals is a business unit on its own. Mm-hmm. Each one has a business plan of its own. What makes those plans come to life? Okay, there are several things, but most important of them are the investors that we have, the partners that we bring into the deal, and also the people that we have to carry on the day-to-day performance and operation of that business plan. So we wanted to then instill that level of incentive and ownership mentality to the people that are providing this, that are making this business plan come to life. So doing that has reduced our turnover significantly. So for every deal, we carve out, as an example, we carve out X percentage of the results of the profit. And when I say we carve that out, that's the portion of the profit that comes our way. So our investors have a very solid and transparent formula as to how they get the distributions, and whatever comes our way, a piece of that goes to our employees, and everyone in the company then becomes really have an ownership interest in every one of these undertakings, of these projects that we undertake. So that's how we kind of brought those together, and it was one success in coverall, and we are seeing a similar one happen at Interwest.
I love that strategy. I think that, maybe people, I think sometimes when there are ownership or employee profit sharing incentivizations, some people might argue that that's, you're taking money out of your own pocket and reducing your own, I guess, net profit. But I don't even really think that's true. I think if you've got a incentives aligned and everybody on the team is kind of got the same goal in mind and it's beneficial to all, you're going to be able to grow and have more success, and you talked about things like retention, that's in the real estate space. You want employee retention, you want investors to invest multiple times, and you want ultimately your residents to stay in the apartments. So retention piece is such a huge part of success in the real estate space. It's like
Exactly.
the best thing you can do is have tenants that stay for 10 years, 20 years in the asset, and they're getting some level of increase in rent each month. That's kind of the dream tenant. And I think there was a time there maybe we got away from that, when through maybe 2021 2022 got a little bit away from that, but the real long-term win is to have retention kind of across the board. And so I think that your focus on that and the way that you incentivize people is incredibly smart. What markets are you invested in, and what markets do you sort of think are particularly good at this time?
A good question. So we are active in Southern California, in Inland Empire, in different parts of San Diego. We are in Arizona, in Phoenix. We are in Nevada, in Las Vegas. We are in Texas. So the target markets are Texas, are North, Middle, and South. Dallas, San Antonio, Austin, Houston. We are in parts of Midwest because we love some of the economic drivers there that have been persistent. We are in Florida, in different markets in Florida. We are we've been in Nashville and Chattanooga, have been other target markets. So we are covering a number of different markets throughout the Smile States. And the strategy that we undertake is really one of value add as well as core plus. And we are very sensitive to what economic drivers in each market. We want to make sure they're diversified. We want to make sure that they're long-term. We want to make sure there is not too much supply coming into the market. And we always adopt a very conservative profile of risk undertaking. And the reason for that, Jason, is that when I started this company, which was in 2003, about 20, almost 22 years ago, we really started from a standpoint of, again, I wanted to do something a little different. So I put together a team to buy distressed debt on real estate properties. And so we were active in that, and we weren't really having any outside investors at the beginning. And we went all the way to 2008, and up to that point, no outside investors. We had a big line of credit from Goldman Sachs that allowed us to do all of these activities. We had a good track record. 2008, that line of credit went away because of the financial downturn. Mm-hmm. And so then we started opening up to outside investors. We have had and continue to have a number of institutional investors that became our partners. And then we also opened up to private investors, family offices, etc. But by going into and buying this distressed type of loans and properties, we saw firsthand what would happen when a property goes upside down and what have been the underlying reasons. And a lot of those reasons were really the miscalculation of the risk and the way that they would come in and they would assess one risk to be here, whereas it would be significantly more. So we were very successful doing all of that. Those distress environments went away, and we continued then being really this value add focus and core plus. But then we come to today, and between 2021 and 2024, in that 3-year period, there had been a lot of acquisitions that were done based on really, in my opinion, very outlandish type of assumptions. The interest rates were low. The assumptions were that these interest rates are going to remain low. You're going to buy this product at a very low cap, meaning I'm paying a lot of money for it. I'm going to do X, Y, Z, and therefore I'm going to add the rents that would be here, and then I'm going to exit this at even higher value, at a lower cap rate than when I came in. And these were very aggressive assumptions, and which led into people now having a lot of properties that are upside down in that arena, and in real estate being cyclical, from 21 to 24 was not really a good time to buy. It was a good time to sell. Now it's a good time to buy, because now you have all of these situations that have translated in price adjustments. Interest rates are higher, but they will get to be lower. But this is the time to really harvest opportunities. And that is the reason we are now really focused on buying newer products with great cash flow in markets with really long-lasting economic drivers. And we want to add to our list of investors and partners that can come on this journey with us. We were very successful the last downturn, and we are hoping to repeat that again on this one.
Yeah, thank you for that. I was when you when you started talking, having gone through the great financial crisis in 2008, and the distressed properties, I wanted to get your take on kind of what you're seeing now. So thank you for you read my mind and got that out there. Yeah, I think it's been an interesting few years, and I think probably still some surprises showing up over the next couple of years. But I do think that almost out of necessity, there is a lot of opportunity in the space now because of kind of what happened the last few years leading up. One question on the markets, Alex. There's a lot of people out there that don't think you should invest in California. You and I both live in California. I don't agree with that, and I also think it sounds like you don't agree with that. So I wanted to just get your take on what you think about. Said you're investing in Inland Empire and San Diego. So I mean, these are Southern California markets. People talk about a lot of negative here, but I'd love to get your, as someone who does actually invest here, kind of what's your take?
Sure. So good points. So there are obviously, I think everybody agrees on this, that Southern California as well as Northern California, but we've been focused more on the South, has incredible economic diversity as far as economic drivers, companies, and employers, and these are not going away anytime soon. For example, in the Inland Empire, you have all the logistics, all of the healthcare systems, and these are huge employers in those areas, and there's a lot of back office type of activities that happens there, and they're not going to go anywhere, and it's a much more affordable geographic area than, for example, when you move further west to Los Angeles, Orange County, etc. So we feel very at ease with the future of Inland Empire. We think that area is going to have a long-lasting future around it. Coming down to, for example, San Diego, similar story. You have a lot of technology companies, a lot of biotech. You have the military. You have again the health systems. You have a lot going on here, and like everything else, this is where you always need to pick pick not your battles. You need to pick your opportunities correctly. I think everything comes down to what you're buying and how you're buying it. And so, we are, for example, this San Diego is the one market we actually are doing ground up development in. And the reason for that is we acquired the sites before there was a measure that passed in San Diego called Complete Communities Plan, which gave, they wanted, in order to solve the housing problem, they the officials wanted to come up with a way to motivate development and encourage that. And so they came up with this plan that in certain areas of San Diego, by right, you will have a higher density. Before that plan come into play, we felt that is going to happen. So we acquired properties that had a much lower density potential. And so that means at really good levels. And when it did come into play, the values of these lands obviously went much higher. But because of our basis, we were able to build these projects to a yield on cost that is much more attractive than if somebody else comes today and wants to buy the land and do all of that activities today. So it was the right bet at the right time for the right opportunity here in Inland Empire. Again, you got to pick your opportunities correctly and make them based on some realistic and conservative assumptions. Again, because of the fact that we deploy a lot of our own capital into every deal, we always look at the downside risk. So we have to make sure that we are well protected on our capital. And then going in with the way that we underwrite, we look at, Jason, probably 200 deals, potential deals, and we pick, we ultimately get one. Right. So it's a very, it's not, we don't do one deal every week or anything like that. It's because of the way that we underwrite, we just can't get to the prices that somebody else may get to. And so that's really bottom line of how we, why we like these markets and how we, think we can be successful in that.
Yeah. No, very, very well said. I think it just comes, people talk about everybody knows, real estate is location. And that's true at many, many different levels. And it also goes back to sort of what we touched on before, where your business plan is specific to that asset. And so your business plan in San Diego is going to be different than your business plan in Inland Empire, is going to be different than your business plan in Houston. Like, it's just a matter of kind of knowing what works in which market with which asset class, as you said, picking your opportunities well. So I think, thank you for that breakdown, Alex. And so I'm going to switch gears here so we get the chance to I want to ask you the questions I ask every guest. The first one is based on the name of the show being Know Your Why. So Alex, what is your why? What's driving? You've had success in multiple different lanes, from commercial cleaning franchises now to real estate. Kind of what keeps driving you forward and keeps you excited about the future?
Good question. I would say that I think every person has some inherent kind of engine or drive, if you would, and I think when it comes in my particular case, I've always looked for balance in my life, and I was fortunate to have to have good support system from my family and my birth family, and then my own family later on. But marrying that to the fact that you get up in the morning, there is something that you want to be passionate about, you want to be excited about, that is going to add value not only to yourself or to the people that you love, but also to the general, to everyone else. And so initially in my life journey, I started what I did in Coverall from a standpoint of, I had no resources and I really wanted to create something that would allow me to do other things in my life. And so that was my driving force then. Later, where I had the capital, it was really, my kids were little. I was very young when I sold my first company. And so it was not time for me to say, I'm going to hang up the shingles. And I really wanted to find the next passion for myself. It took me a few years to find it. I went through a number of different iterations. Finally, I landed on this one, the real estate side. And it really excited me because it also lined up with my educational background. And so I became more and more excited, but primarily because as an engineer, you're a problem solver. Mm-hmm. And that what drives me with this, what I love about what I'm doing today, is the fact that each one of these the opportunities or deals is a new story on its own. It's got a set of different complications. It has a set of potential opportunities, and it becomes, it's how creative you can be and how good you can be in putting all the pieces together to, number one, buy that or take on that opportunity, but then more importantly, how you're going to operate it and get to your results. So I get that motivation because each one of these things that we undertake really does excite me. It's like building a new business on its own. And so that's what really drives me today. Obviously, when you make money on a deal for investors and you have happy investors, and when you make money, the people in the company make money as well. So when all of that happens, you see smiles around you. And so that's another motivating factor. So all of this, but, again, there's a lot of ups and downs and, curves that come into play. But ultimately, if you keep the course in view at all times, and if you go a little past it, up or down, and you get back on track again, okay, and the more, I think with my, the number of years I've been doing this now, which is 20 plus, and the set of experiences, I think what I've learned best is how to get back on the track, how to not let a short-term, what you call setback, dictate the overall outcome of a situation. And so I think that's probably the value that I've gained from all the years that I've been doing business.
Yeah. Sorry about that.
No worries.
I don't know why that keeps happening. Well, I mean, I love that sort of perspective, and that you've kind of cracked the code on solving the next setback or getting getting through whatever hurdles might be presented. I think that's just, it's an incredible skill to have. It's also a skill that takes a long time to develop. So I think that the giving you credit for the years in business and real estate and having survived multiple market cycles and all that, it's just very, very impressive. And so I love that sort of perspective that you come to it at this point. Well, Alex, this conversation has been fantastic. Thank you for coming on the show today. I appreciate everything that you shared. I love hearing your background and your perspective, both in the business and the real estate world, which really realistically kind of overlap. So thank you for being here. Thank you for sharing your story.
Thanks very much, Jason. It was a pleasure to be with you, and hope to keep in touch with you moving forward.
Yeah, I would love that. And I almost forgot. How, when people hear this and they want to connect with you, how should they reach out to you?
Okay, thank you for that. You can reach out to myself personally. The name of the company is obviously Interwest Capital. And my email is alex@interwestcapital.com. And our website is interwestcapital.com. And if you can visit our website and send me an email, we would love to schedule a one-on-one Zoom call and get to know you as well. At the current time, we are looking to increase our platform of investors and partners, and so we would love to hear from your listeners.
Absolutely. We'll have that in the show notes so people can find you easily. Again, thank you for being here. I really do appreciate your time. And folks listening, please make sure you connect with Alex. Please like, rate, and review the show so we can continue to get great guests. And as always, thank you so much for listening.
Thanks very much. Have a good day. Take care.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?